Welcome to The Deep Dive. We're the show that cuts through the noise, takes stacks of sources, and gives you the key insights. Today, we're digging into Gogoro Inc. That's ticker GGR, their Q2 2025 earnings call. Really fascinating stuff happening with electric scooters and battery swapping.
Yeah, the big question is, can they pull off this pivot? Moving from mostly selling scooters to being, the core platform for battery swapping. Everything we'll talk about, the financials, the strategy, it all comes back to that. So our mission today, unpack the numbers, see what moves they're making, and figure out what it means for them and, well, the whole market.
Exactly. And this quarter really, it really highlights their journey. You see the pressure, especially on sales in Taiwan. But at the same time, you see real progress operationally, strengthening that recurring revenue. It's like they're fighting headwinds, but building muscle internally.
Okay, let's get straight to the numbers then. The results snapshot. For Q2 2025, GAAP EPS was -9 cents. Now, GAAP, that's your standard accounting view, so a loss there. On the surface, maybe a bit worrying. It is. It's the starting point. But, like always, you got to look deeper, right? Total revenue, $65.8 million, down 18.7% year over year. That's a pretty big drop. But here's the twist. Their non-IFRS gross margin actually climbed to 17.0%.
Non-IFRS, so adjusted for some one-off things.
Exactly. Gives you a better feel for the core business performance. And 17%, that's up 350 basis points from last year.
Wow, okay, 3.5% jump in core margin, even with revenue falling that much. How did that work? Seems backward.
It does feel a bit counterintuitive, yeah. But it really shows where their focus is. The battery swapping service revenue, that was strong. Up 8.5% year over year to $37.6 million. That's the subscription model, the recurring stuff. And it's holding up really well.
Okay, so that's pulling up the margin.
Right. Meanwhile, the hardware side, selling the scooters and other bits that dropped significantly, down 39.1% to $28.2 million. That's what dragged the total revenue down.
So a real tale of two revenue streams, but it sounds like they're also tightening their belts. Operating cash flow looked way up for the first half.
It did, yeah. $15.2 million for H1 2025. Compared to just $4.8 million same time last year. Big jump.
Where's that coming from?
A good chunk, about $11 million, came from cutting operating expenses, OPEX savings, just running leaner day to day. And importantly, even with sales pressure and cost cuts, their subscriber base kept growing, up to 648,000 total subscribers. That's a 7% increase year over year.
Okay, so top line pressure, hardware slump, but battery swapping, it's growing, margins improving operationally, cash flow up, subscribers growing.
Exactly. It's a mixed bag.
Right.
Which is why the market had this sort of cautious, but maybe slightly optimistic reaction. They see the challenges, but they also see the strategy working in key areas.
Right. So let's unpack that strategy more. We've seen the snapshot, that mixed bag. But beneath the surface, it's clear this isn't just weathering a storm, it's a deliberate shift. That split in revenue streams we talked about, that really tells the story, doesn't it? The battery swapping growth shows how solid that recurring model is.
It's incredibly solid. Think about it. Scooter sales plunged, partly because the whole Taiwan market shrank 11%. Plus, they had a product launch delay. But that subscription revenue, rock solid. It's just once you're in the Gogoro network, you tend to stay. Very sticky customers.
So the long-term value is in the network, not just the scooter sale.
Precisely. It underlines that pivot. Management's deliberately moving away from relying just on hardware sales. They're focusing hard on the economics per user, on building out those energy services.
Like moving from selling CDs to selling Spotify subscriptions, kind of.
That's a decent analogy, yeah.
Yeah.
And the margin story gets interesting here, too. Remember that tiny 0.3% IFRS gross margin?
Yeah, dragged down by something. A battery upgrade program.
Exactly, a voluntary battery pack upgrade program. But the non-IFRS margin, the one showing core ops, was that healthy 17%. Huge difference.
So why the big gap? What's this upgrade program about?
It's key to understanding their long game. Management sees this as an upfront investment. They're putting newer, better battery packs into the network. These packs last longer, make the whole network run more efficiently. It hurts the official IFRS margin now.
Because it's a cost.
It's a cost, yeah. But they expect it to boost the bottom line later this year and into 2026. They're taking a hit now for a more efficient, reliable network down the road.
Short-term pain, long-term gain. Classic playbook. But it's a calculated risk, right? What if those gains take longer to show up?
It's definitely a risk. If the market stays tough or competition heats up faster, but their conviction seems pretty high. They believe this makes their core asset, the network, much stronger.
And it ties into that operational discipline you mentioned, the OPEX savings, the cash flow jump.
Right. Management used phrases like strategic streamlining and prioritizing agility.
Buzzwords maybe, but what does it mean practically?
It means cutting back on scooter models that weren't selling as well, focusing R&D on core tech and high-demand products, like trimming the fat, really focusing resources. That's where the $11 million in OPEX savings came from so far this year. It lets them manage the bottom line better, even when sales are soft. Shows they can control costs.
Makes sense. And controlling costs helps with liquidity, which is always critical. They ended Q2 with about $92 million in cash. But they also took out a new loan.
They did. Drew down about $68.3 million US dollars worth of Taiwanese currency in June, into $2 billion.
Why now?
It seems proactive. They said it was to boost liquidity, strengthen the balance sheet, just in case market uncertainty continues. A buffer.
So not a sign of trouble, more like preparing for anything. Gives them room to keep executing.
Exactly. It funds the strategy without immediate money worries.
Okay, let's shift to what management is saying about the future. Guidance and insights. To fight those market headwinds, they launched EZDY, an entry-level scooter around $910 US after subsidies. And they said demand was significant since it hit the market in July. Feels like a move to broaden the appeal.
Definitely. Lowering the entry price point in a tough market makes sense, trying to get more people onto the platform. And they're innovating on the service side too. Launched a new pay-as-you-go energy plan.
So not just unlimited plans.
Right. Complements their existing off-peak unlimited plan, caters to people who maybe don't ride every day, more flexibility, trying to lower barriers again.
And more new products coming. A high-performance entry level in Q3, a whole new platform in 2026. Sounds ambitious?
It is ambitious. Shows they're still investing in the future, despite the current climate. But these plans have near-term impacts, too. They actually adjusted their full-year 2025 revenue guidance, now expecting it to be at the low end of the previous $295 to $315 million range.
And why the adjustment?
Mostly because that EZZY launch was a bit later than first planned. Shows how sensitive things are right now.
Okay, so near-term bumpiness impacting the outlook slightly, but they seem confident longer-term. They reaffirmed profitability targets.
They did. Still projecting the battery swapping business hits break-even in 2026, energy cash flow positive by 2027, the vehicle business profitable by 2028, and the whole company profitable in 2027. Those are the big milestones they're aiming for.
Bold targets.
Very. They believe the hard work of repositioning is paying off. For you, the listener, it means trusting that current investments, like that battery upgrade, will lead to these future profits.
But the wild card is always the market, competition, maybe regulations.
Absolutely. Which brings us nicely to the investor context. What does this all mean more broadly? International expansion is key here for long-term potential.
Right. Beyond Taiwan. You mentioned Korea.
Yeah, it's seeing more demand there for business-to-business uses. But the bigger one, potentially, is Vietnam, their joint venture with Castrol. That seems to be moving forward. And importantly, the Vietnamese government is making positive noises about electrifying two-wheelers. Tailwinds.
Yeah, so when do we see results from Vietnam?
Don't expect big revenue next year in 2026. But they're laying groundwork. A pilot by end of this year, full launch planned for 2026. It's about exporting the whole battery swap system. Huge potential if it works.
And back in Taiwan, government policy is also a front-runner, net zero target.
Big targets for 2035 and 2050.
Yeah.
Gogoro's talking to the government, expecting stronger subsidies or rules to push EV adoption faster, maybe starting 2026. With 15 million scooters in Taiwan, that's a huge market waiting to be converted. Gogoro wants to be ready to scale up when those incentives kick in.
But if those subsidies get delayed?
That could slow down their path to profitability in Taiwan, definitely. It's a timing risk.
Which brings us to their stock market situation. They moved to the Nasdaq Capital Market in May.
Basically to get more time. They needed to get their share price back above $1 to stay listed. This move extended the deadline to October 27th, 2025.
And they also got permission for a reverse stock split.
Yep. Shareholders approved, authorizing one up to 100 for one if management decides they need it. It's about keeping their options open to stay lifted while they execute this turnaround. Buys them breathing room.
Makes sense. So looking at the stock itself, it's lagged the sector, like the DRIVE ETF, over the past year, but a bit of a bounce recently.
Yeah, outperformed in the last 3 months, but from a very low base. The market sentiment feels cautious, but maybe willing to be convinced. Investors are waiting for proof points.
What are those key proof points, those catalysts?
For you, the things to watch are that Q3 vehicle launch, does it gain traction? Any solid news from the Vietnam JV? finishing that battery upgrade program smoothly. And of course, what happens with the Nasdaq compliance by that October deadline. Hitting these marks is crucial to build confidence.
Okay, now let's shift gears. And I have to say this very clearly. What follows is for informational and entertainment purposes only. It is absolutely not financial advice. Please do your own research. Got it. Good. Okay. With that said, let's talk about an outrageous but maybe plausible trade idea for Gogoro, playing on both the short-term pressures and that long-term story.
All right, so you've got the stock hovering around, 37 cents, and this looming October 27th Nasdaq deadline. Huge potential for volatility there, especially with a possible reverse split up to 100 to 1. One idea could be a short-term options play, a long strangle around that deadline.
Buying both a call and a put.
Exactly. Buy an out-of-the-money call and an out-of-the-money put, both expiring just after October 27th. You're not betting on direction, you're betting on a big move. Either a pop if they sort out compliance, maybe with a split, or a drop if things go sideways.
Hedging against that binary event.
Yeah.
And longer term.
Longer term, that Vietnam JV with Castrol seems like it might be underappreciated by the market right now. Favorable government signals. Launch plan for 2026. So maybe a bullish call spread with a longer expiry, say late 2026 or early 2027. Buy a call at one strike, sell another call at a higher strike.
Makes the bet cheaper.
Right. It's a cost-effective way to play for gradual upside if Vietnam starts delivering and their operational improvements continue. It needs patience, though. You have to let that story play out and trust management to hit those profitability targets.
Okay, so wrapping this all up, what's the bottom line for you, the listener? Gogoro is definitely a company in transition, making a very deliberate shift to recurring revenue, getting leaner operationally, but doing it in a tough market, facing these critical deadlines.
Yeah, the focus on new products like EasyDY, the cost savings, the push into Vietnam, you're starting to see signs it might be working. But the market's still watching. Needs more proof.
So keep an eye on scooter sales in Taiwan, obviously, how those new launches perform, and definitely track any news out of Vietnam. Those are the signals for whether the long-term plan is on track.
And don't forget that Nasdaq compliance issue by October. That's the immediate hurdle.
We've covered a ton. JAP versus non-IFRS margins, the EasyZY launch, the Castrol JV, liquidity moves, the Nasdaq situation. It's a complex picture. Thanks for joining us on this deep dive into Gogoro's Q2 2025. We hope it helps you navigate the fascinating world of electric mobility and battery tech. Keep exploring. And maybe the final thought for you is this. How do you weigh that balance for a company like Gogoro? The immediate market challenges versus the potential prize of becoming a dominant global platform for battery swapping. It's a high-stakes game.